Hello friends, welcome. Friends, I don't know whether you have seen this report. This is a World Bank report which has been recently released in the month of September 2024 to give a India development update. Now, since this is a recent report, I think some of the newspaper picked up and they only pointed to the growth number of 7% of the GDP. But this report actually has got some crucial, constructive, criticism, which we need to look into in order to understand some of the policies that India is being undertaking in order to drive its growth and GDP forward. So, friends, I am doing this video to take you through some of the aspect of this report which is very, very crucial for us to understand so that we can have a very realistic framework in our mind as to where we are and where we are heading and what kinds of improvements that are required for India to grow faster as regards its financial aspirations concerned. That's the whole purpose of this video. So friends, what I did was I have gone through this report in detail and I have I underlined the key important points for us to focus together. So the first important point in this report, which is pretty significant, it says that the global growth softened to 2.6% of the GDP, 2.6% year on year in 2023, and it is estimated to remain muted to 2.6% in 2004, significantly below the COVID level. Now, this is very, very important because global growth estimate is going to be a dampener as far as any development countries like India to drive its economy forward, because most of the time we are related or dependent upon international support as regards to trade and commerce to drive our GDP. So this 2.5% is going to be a dampener and it is significantly below the pre-COVID level. So this is the point to be noted. This is very, very important point to be noted, which we have to understand as we progress forward. Then what it says is, so there are certain things which they have written regarding the current data. So because they have laid out the data about fiscal deficit, etc. All those things we are aware of. So I'm not going to repeat those things. The other thing that they are talking about, which is very, very significant, is the rise of our public debt. Now the public debt has risen to 84% of our GDP. And it was in 70s before pre-COVID level, and suddenly it has increased to 84%. It was within the 70s number. Now, I don't know whether you have heard, RBI in recent times stated that going forward, this public debt is going to be the metric rather than fiscal deficit to measure our economic health and progress as you move forward. What is fiscal deficit? Fiscal deficit is the gap within the government accounts for a particular financial year. Means whatever we have not earned. Earned means either through revenue or through capital receipt, which are non-debt in nature. So, which we have not earned and we are spending, which basically means that we have to borrow money from the market in order to make sure that we have funds for those spending which are not being replenished by income in terms of revenue and capital receipt, which are non-debt in nature. So that's fiscal deficit. Now fiscal deficit, it contributes towards this growth of public debt. This is important to understand because year on year you keep on taking fiscal deficit and that keeps on adding to your overall debt. Because that debt that you keep on retiring, because when you retire debt, that is not part of your national budget. The national budget does not take into consideration the principal repayment that you are doing on debt. It only takes into consideration the interest payment. Okay, that's how the national account is structured. Now, when you take fiscal deficit, if you make your fiscal deficit higher, then what happens is that you have to keep on taking new debt then compared to that you pay, and that is driving your overall public debt, and which is now as high as 84% of the GDP. Now this is extremely crucial in order for us to ensure that we are well within our growth trajectory. We have to keep this number as low as possible. Now you may ask why you have to keep this number as low as possible. Now imagine that your GDP is what? GDP is roughly around 320 lakh crores, right, for the fiscal year FY 25 23 FY 24 25. This is the 320 lakh crores. Now if you take a 84% of 320 multiplied by 0.84, it comes out to be 268.8. This is the total public debt. Now if you assume a 7%, a modest interest payment, 7% interest payment, can you imagine the amount of interest payment that you have to make? You have to make an interest payment on a yearly basis of 18 lakh crores. 19 lakh crores. Now you know that the central government is making an interest payment which is close to around 11.55 lakh crores. The budget, see, their capital expenditure and interest payments are almost similar. So rest of the interest payment is basically for the state fiscal deficit, etc. So this will be as close as 20 lakh crores, which is going to strain our national accounting, the budget that we are doing on a daily basis, because if we replenish our income in terms of revenue and capital received in payment of interest, imagine how much money that we will be left with for our progressive activities like investment, etc. That is why this is very, very important. We have to keep a close tab on our overall public debt, right? So that is that IMF has pointed out. Then what it basically says, I will not go into other items because there are many things which has been said. I am going to only point to the important items. It says that we have a target, India has a target of achieving a $1 trillion export by 2030. I don't know from where this number has come, but I am just seeing this number in this report. Now currently exports are roughly around $420 billion, something like that. I have to look at the numbers. So this is well below the $1 trillion number. So for India to achieve $1 trillion exports and be part of the exploit the global value chain, they call it GVCs, we have to undertake many reforms. So this report, actually, if you look at this report, the large part of the constructive criticism or the recommendation is laid around India's inability to leverage the global value chain. This is important. India's inability to leverage the global value chain. So I will talk about it. And what it also says that India's participation in the global value chain has fallen, and it is not labor intensive. Why it is important that India's participation in global value chain has to be labor intensive? Because if it is not labor intensive, then the advantage or the benefit of exports will not get realized by the larger section of the population, and because of jobs are going to be hit. And here what IMF is saying, that most of the exports India is doing are capital incentive where the amount of contribution of labor is minimal, and which is the matter of concern. So that's where there is a recommendation which IMF is talking about, that we have to look into in order to improve our contribution further in the global value, or leverage our exports to leverage the global value chain. Now let's forget about the economic numbers. I don't think that is important. There is one thing which actually IMF says, which I have been pointing out in all my videos, is the fact about discrepancy. This discrepancy, which has become extremely volatile in our GDP projections or GDP numbers that we're talking about, IMF has also pointed out about this. It says that variation in discrepancy were significant in FY 23-24, leaving much of the demand side growth unexplained. And this is really a matter of concern. If you are going to have discrepancies which is going to be as high as, on a quarterly basis, I'm talking about, as high as 1.3 lakh crores, 1.4 lakh crores, imagine how can anybody make any kind of projections about the GDP growth. It is impossible because the number are going to be so substantial that any kind of growth that you predict about any other line items, public sector expenditure, government expenditure, etc., consumption expenditure, etc., those are going to get somehow subdued and nullified by the discrepancy number, which can be either positive or negative, and that positive negative is a large number, and it is extremely volatile and unpredictable, which IMF have also pointed out in their report. Now let's go and look at some other items in this report. By the way, this report is actually important for everybody to look at, because when other people looks at us from outside, we have to see and understand what is their perception, because this perception gets created by our global counterpart, and that impacts FDI and all kinds of interventions that they are trying to do in India. That's why these reports are very, very important. Now, there is a positive thing which this report talks about. It says that India's asset quality has improved. Now, this is very, very good, because that we had a lot of defaults and bad investments, where people have just run away, without paying loans, and banks actually have lost money, and the debts were finally, taken out of their book to clean up this book. So they're saying the asset quality has improved, and we had, which is significantly better, and our NPA has become much lower compared to what it was earlier, which is a very positive thing. Okay, and then it also says, and this is very, very important, by the way, which is our yield curve. The yield curve of our long-term bonds have flattened. Now, why yield curve is important for long-term, flattening of yield curve for long-term bonds are important, because this is basically an important metric by which various kinds of valuations are done. And when the yield curve goes down, then it's advantageous to the Indian government, because lot of interest outflow is tightly coupled with the yield curve. Because if your yield curve is higher, let's say if you have to pay 7.4 or 8% interest payment for the debt which Government of India sells to the various counterparts, then your interest payment outflow is going to be higher. But if your yield goes down to 7%, 6%, then your interest payment obligations are going to be lower. So looks like that our yield curve is not growing higher. So our interest payment obligations, and that is the reason why if you see fiscal deficit, this budget account has slightly gone down, right, compared to what it was in the February projection, primarily because of this. Because we have our bonds have been listed in the global market, it is going to be listed, and that is going to create demand. And there is one more factor of demand on Indian bonds, is because there is a perception that US and other markets are going to bring down their interest rates. So if the interest rate goes down, their inflation is going down, and their bonds are going to give lesser return. So India is still giving a return of 7%, and therefore it is lucrative compared to other markets investors. So let's go down further and look at some other important points which I have underlined. So fiscal deficit we have spoken about, and then let's talk about other things. State fiscal deficit is a matter of concern, because that's where it is getting uncontrolled. Not very high, but still there is a lot of discipline which is required, because central government is trying they're trying really hard to reduce their fiscal deficit. So we have to have a strong discipline as far as our states are concerned from handling their finance. Okay, then if you go down below, what it talks about outlook. Now, from an outlook point of view, it says that India's growth is stable, and it is going to remain strong and will grow at 7%. This is what was picked up in the headline. I consider this a very insignificant, part of the report, because there are many things which should be, spoken about in the newspapers than only this number, because this number is sometimes may not be accurate because of discrepancy in other external things, etc. There are constructive feedback which this report gives, which should be picked up, because those are important feedback which if we improve, then we can grow much higher than 7%. So let's see what are those feedback which this report is talking about, and we'll go straight to okay. Before we go straight to the feedback part, we have to also take into consideration what they are saying, that that India, if you look at this, what it basically saying that India's path to greater trade and global value chain participation is in a challenging global context. What it is saying is that our economic policies have a significant portion of trade distorting measure. So there is a significant portion of trade distorting measure, and with most active participant including US, China, India, and most of the EU economy. Now what it is saying is, if you look at this graph is saying that this is figure 4.1, trade distorting measure in global context, and there is a red line here, and in this red line it is saying that the emerging market and developed economy, look, India is here, right? And then the higher GDP economy. So this is the number of measures, right, here, and this is basically the GDP. So if you look, India is still on a very higher pedestal on the number of measures, right, trade distorting measure. So I think this is important, and rest of the, like Vietnam, China, etc., look, they are lower level, which is a matter of concern, right? So that is one point which I thought. But there are opportunities that India can leverage. So let's look at what are the opportunities. Now, here it is an important point to be mentioned. So what it is saying is, if you look at this report, it's saying on trade, India is punching well below its weight. Means we are not doing the full potential that we have. And this is a very important line to read. Despite its rising economic heft, India's trade in goods and service has been declining as a percentage of GDP over last decade, and it is lower than countries with similar stage of development. Can you see this? So we are not performing to our potential, and it is lower than countries at similar stage of development, right? And this is the graph which they have plotted where India is being marked here, right? And then also it says that India's exports have evolved recently, but more can be done to push intensive, extensive margins. So it talks about service export, and it basically praises our India service export, and it is saying it is growing, but there is a problem here. It's saying still in year 2022 it caters for just 4.3% of the global services demand, and there is a significant potential for further growth. Means though service growth export of India is high, but it is just creating for 4.3% of global services, which is pretty low, right? And then it basically says that we need to diversify. Let's forget about this. Now what is this? This is an important graph which I just marked, which says that India's export growth in service export and India's export in goods. So India is doing good as far as service. So look, this is the service chart, and there are many countries here. We are doing great, but as far as goods are concerned, growth in goods, here is the dotted line India compared to Vietnam and other. Vietnam is doing great as far as goods are concerned. India's exports are relatively, this is important. So what it is saying is that if you look at this particular paragraph, this is a problem. Our exports are capital incentive, and I will read out this. Direct employment related to export has fallen from a peak of 9.5% of the total domestic employment in 2012 to 6.5% in 2020. There was a similar trend in indirect employment, which peaked in 9.56% in 2006, fell to 6.44% in 2020. This is because India's exports have increasingly consisted of skill intensive manufacturing and services. And that's why we have a problem of employment. Because our exports are intensive in manufacturing services, and because these sectors are highly capital intensive, they are ill suited to employ a large share of India's workforce. So look at this feedback. We have to take this feedback and do some drastic changes in our export policies, right? Where we are basically giving incentive, etc., like chip market, right? It's a highly, investment focus. Exports, even if you try to do it, because if you put a chip factory in India, the amount of investment that is required is in billions of dollars, but there will be no jobs because there will be all robots which are going to run the show, right? Then here he talks about India's high and low incentive manufacturing. If you see here that percentage of global manufacturing of exports. So India is, so if you look at this, what is this? So India's high and low skill incentive manufacturing percentage of global manufacturing of export. So this is basically on percentage of global. So it's very clearly saying that look, it is almost like reaching 65%, and low skill is reaching a bottom level of 35%, right? Yeah, so high skill and low skill manufacturing, we have saw that India's major portion is focused on high skill, where there is a problem, right? Which IMF report is talking about. It talks about more labor in greater trade diversification, upgradation in deeper. This is basically a recommendation that we have to do. Again, it talks about labor, which we saw 70% and 20% we just saw. Okay, this is important. This is basically very, very important. It says that China withdraws from low skill manufacturing due to increased wages, and India has the potential to capitalize on this opportunity. Now, what it is, this paragraph is extremely important. It says, as China's participation in low skill manufacturing decreases due to rising wages, India can do more to capitalize on this opportunity. Currently, countries such as Bangladesh, Vietnam, and even advanced economies like Germany and Netherlands have become the primary beneficiary of China's shrinking market share in low skill manufacturing. This is really a matter of concern. Since we have to anticipate, and we have to basically steer our policies in such a way that if China is facing constraint in the low skill manufacturing, we have to latch on that opportunity. I don't know why we haven't been able to do that. And this is a very, very important point, and this should have been the headline of this report, right? And then if you go down below, most of the things actually we have spoken about. There is nothing much to speak about. There is one thing which I wanted to show you, which is, this is important. See, look, we have been, doing gaga about our mobile phone exports. We're saying India is doing great on mobile phone exports, and it has become significant part of our overall export strategy, basket. But look at this. Vietnam, India's global share in mobile phone export and import by remain borders. We are just 2.4% in 2022, whereas Vietnam is 13.2%. Now it is in growing trajectory. India is still growing, but it is not at this gradient. So this is important. Though we are doing very great as far as mobile phone export is concerned, we do not have any competition to countries like Vietnam, which is a matter of concern. I don't think that anything else needs to be spoken about. I have highlighted major part of this report. I think that's all. You can read through this report. It's available in the IMF website, and I thought to talk about this report because there were some significant recommendation and constructive feedback in this report. So I hope that you have taken those into consideration. And I'll thank you for listening to the end, and I'll come back to you with a new video next time. Thank you very much.